Is a HELOC more dangerous than credit cards? The answer is no and yes. I want to run through and debunk a few of the HELOC versus refinance, credit cards, whatever it may be. And today we're going to go over a couple of them, but the first one is going to be, is a HELOC more dangerous than a credit card? As I said, it is no and yes. If you're looking at consolidating debt, HELOC is probably a better option than a refinance, and we'll go over that soon too. But the truth is, when you're looking at just moving money from credit cards to HELOCs, there's a couple things you have to think about. And the first is HELOCs put you in a better position, at least financially, because you're going to lower your rate. You're going to cut your interest anywhere between 60 or 70% just because of the difference in rates between a HELOC and credit cards. And all this means is for every $10,000 you have in debt, you're going to save 60 to 70% in interest. That's just interest going away, interest going to the banks, wherever it is. That's coming out of your family, your money, your pockets. You have to think about this and everything. This is not something that's going to take a lot of time, a lot of energy out of your life. This is just something, a quick fix. When we talk about smart with debt, it's all about bringing your cost of debt down, making sure you're paying the least amount for what you have, not putting another burden on you of trying to figure out daily how to get through and how to budget things and envelopes and stuff like that. But how do you chunk this down? How do you put more into your life? And this is a perfect example. Let's look at a credit card and HELOC, the real numbers. If you have a $10,000 in debt and you have money on a HELOC, right now HELOCs are about 8%. So if you have $10,000 on average or an estimate over a year period, you're going to pay about $800 in interest to the banks. Now, if you have that same money, that same $10,000 with credit cards with banks also, you're going to pay at least 24%. If their store cards, even higher, but let's just use 24%. So you have that $10,000, you're paying 24%. That's $2,400 a year just going in interest. Now, if you quickly look at those numbers, HELOCs, $800, credit cards, $2,400. So that's $1,600 that can be pumped back into your family, your life, as simple as moving it from one to the other. Now, there are risks, and we're going to go over those too, so things you have to think about. But just think of what risk you're lowering. You're putting more money into your budget every month. That $1,600 over a year goes into your budget so you can have easier time making payments. Your budget is not going to be stretched so thin. So it is actually eliminating some of the risk that you have with making your payments, with making those monthly, payments on everything else you have. By simply moving it over to lower interest, you're putting more money into your life and creating less risk in your world. The other debunk out there is HELOCs are more risky because it's adjustable rates. Credit cards, HELOCs are based on the same, what they call base rate or index rate. And these are both affected by what the Fed is doing when they're lowering, raising, whatever they do every month, to every quarter. So those are the same. So if interest rates go up on a HELOC, they're going to go up on a credit card. If they go down on a HELOC, they're going to go down on a credit card. So they're both adjustable. So if you're looking just at apples to apples, HELOCs to credit cards, HELOCs are going to win out just because of what you're paying or what you're keeping in your family, and that's that extra interest that you're not paying the bank and you're keeping it in your account. The simple answer on this side when we say a HELOC is not as risky as credit cards is that with more money, when you're paying 60 to 70% less in interest, that is just more money that helps you get through everything, get through all your payments, to make sure you're up on your payments. So as far as a HELOC, the no is because of you're paying lower interest rates, you're putting more money into your life, making life easier for you and your family. Where are HELOCs more risky than your credit cards? And that's just understanding a HELOC is a mortgage, so it is a lien against your property. The lender has rights to your property. They're using it as collateral. So when you take out a HELOC, you're giving up equity or you're using your property's equity to secure their loan. So the risk comes in two factors. Number one, if you get into a situation and you miss a payment on a HELOC, it will report to your credit and it'll affect it more than a credit card because mortgages have a bigger effect on credit scores than credit cards. Also, since this is a mortgage on your property, you have to think about if something comes up, something happens, you're still short on your monthly payments. you're now putting your house in risk of foreclosure. HELOCs are great if you have the money, if you know where the money's coming from, and this, lowering your payments is going to help. But if it's not going to help, it's just going to delay something that's going to happen in the future where you're going to not be able to make payments. Default, foreclosure can happen. And the third thing is you could lose your home. So huge thing on HELOCs is it is a lien on your property. It is a mortgage. You're giving up that right. That's why the interest rates are lower, because the banks are secure. So HELOCs are a tool. If you're in the situation where you're just moving credit cards over and you were going to refinance anyway, the difference between a HELOC and refinancing is great because you're already going to use your home for security, but you're going to pay a lot less with a HELOC compared to a refinance because it's, you're taking just a small portion of your debt overall because your mortgage is typically your largest portion. And where rates were or where they were in the past, the mortgage that you have probably has a really good rate. So why take something that maybe has 200,000 or 300,000 at 3 or 4% and move it all the way up to like 6 or 7%? If you're looking at consolidating, if you're already looking at moving money over to your mortgage, HELOCs are better than a refinance 9 out of probably 99 out of 100 times. Why? Because you could get more on a HELOC. You could usually get 80 or 85% loan to value. The costs are lower than a refinance because you're refinancing a smaller amount. It may cost you $500 instead of $5 or $6 grand to refinance. And once again, you're not bringing in your good debt, which is your mortgage that has a really good rate, into bad debt. Smart with debt is all about positioning your debt, making sure that you're paying as little as you can. It's not about getting down to the last penny, making sure everything is saved, like saving every last penny. It's all about positioning yourself, going from 24 to 8, getting into a HELOC instead of a refinance. All of these things. Just remember, when you're looking at a HELOC versus a credit card, if you're in a position already where you just need some relief, and that relief will help you, HELOCs are great because it's going to lower your payments, it's going to bring more money in. But if you're in the verge of maybe not making payments because your car payments are going to start being late, your mortgage, it's probably not good to bring more debt over to your house and make you get into a situation where a foreclosure might happen, might put you in a situation where you lose your home. That's where it is. Lower payments, more money into your pockets, but it's also the risk of putting a lien on your property in foreclosure. Now, if you're looking for some tools, check out Smart with Debt. We have a couple of great downloads. One is credit cards versus HELOCs, and the other one is refinance versus a HELOC. If you're looking at anything to reposition some debt, just to put some more money in your pockets, check out Smart with Debt, and we'll see you on the next video.